Welcome to Section 3 of the PNJ Group Income Statement Training Series. Today, we explore operating expenses, how they are classified, and the non-operating items that sit below the operating income line. By the end of this section, you will be able to classify operating expenses by function, distinguish classification methods, apply the consistency requirement, identify non-operating items, and recognize the post-2015 treatment of unusual items. Before we categorize a single expense, it helps to understand why operating income commands so much attention. Analysts and lenders use EBIT, earnings before interest and taxes, because it removes the effects of how a company is financed and how much tax it pays. That makes it the fairest way to compare two companies with very different debt levels or tax positions. A SC 220 requires it to appear on the face of the income statement or in the notes. And in practice, it is the number that drives valuation multiples, loan covenants, and management bonus targets. Selling expenses are the costs directly tied to marketing and distributing products to customers. They include sales force compensation, commissions, advertising and shipping costs paid to deliver goods to customers. Trade promotions, discounts or allowances offered to distributors and retailers also live here. These are period costs, meaning they are expensed in the period incurred rather than attached to a unit of inventory. General and administrative expenses are the overhead costs of running the entity as a whole. Executive compensation, corporate legal and accounting fees, HR and IT infrastructure that does not qualify for capitalization all fall here. So do office facilities and insurance. Unlike selling expenses, G&A costs cannot be traced to a specific product or customer. They support the whole organization. Controlling G&A is one of the clearest signals of management discipline. R&D, research and development, follows a strict rule under a SC 730. Expense it as incurred, period. You cannot defer R&D costs hoping to match them against future revenues. The one recognized exception is software development. Costs incurred after a product reaches technological feasibility may be capitalized under a SC 98520. If R&D is material, it must be presented as a separate line on the income statement, so users can see the level of investment in future growth. 4 expense types deserve special placement attention. Depreciation and amortization, the systematic reduction of PP&E and finite life intangibles, can sit inside COGS, inside operating expenses, or appear as a separate line depending on how the entity structures its presentation. Restructuring charges under a SC 420, severance, lease terminations, and asset write-downs from exit activities, must be presented separately when material. Impairment losses on goodwill, intangibles, and PP&E go even further. They are required to appear as separate line items on the face of the income statement. U.S. GAAP gives entities a choice between two classification frameworks. Function-based classification groups expenses by what they do, COGS, selling, G&A, R&D. This is the dominant approach among U.S. public companies because it supports ratio analysis and operating subtotals. Nature-based classification groups expenses by what they are: materials consumed, employee benefits paid, depreciation taken, and is far more common under IFRS. Whichever method an entity adopts, it must apply it consistently. Any proposed change requires retrospective restatement of prior periods and full disclosure, and must be escalated to your manager before any reclassification is made. Operating income is simply gross profit minus all operating expenses, and EBIT, earnings before interest and taxes, is the standard label. The reason it matters so much is structural. By stopping before interest and taxes, it measures the performance of the business itself, not how it is financed or where it is incorporated. A company in a high-tax country and a competitor in a low-tax country look comparable at the EBIT line. A SC 200 2010-40 51 requires this subtotal to appear on the face of the income statement or be disclosed in the notes. Below operating income sits a different category: revenues, expenses, gains, and losses that are peripheral to the entity's primary business. Interest expense, the cost of carrying debt, is the most significant. It is presented on its own line, and a critical rule applies. You may not net interest expense against interest income unless specific netting criteria are met. Foreign currency transaction gains and losses arise from remeasuring monetary assets and liabilities at period-end exchange rates under a SC 830-20. Those go here too. Equity method income, the investor's proportionate share of an investee's net income under a SC 323, is also typically non-operating. Before 2016, U.S. GAAP allowed a special category below the income from operations line for items that were both unusual in nature and infrequently occurring extraordinary items, presented net of tax. A SU 2015-01 eliminated this category entirely. From 2016 onward, every item, regardless of how unusual or rare, must be included within income from continuing operations. Unusual or infrequent items may be broken out as a separate line and explained in the notes, but they cannot be presented below the line or net of tax. If you encounter a client still using the extraordinary items label, that is an error. Reclassify it and bring it to your team lead immediately. Income before taxes is a required subtotal, not optional. It is computed as operating income plus the net of all non-operating items, and it exists for a very practical reason. Income tax expense and any discontinued operations are each computed and presented separately. By showing income before taxes as a clean subtotal, the statement lets users apply their own tax rate assumptions when building models or comparing across jurisdictions. One discipline reminder: avoid large catch-all amounts in other income and expense. Every material non-operating item needs its own description. Let us bring this together. Operating expenses follow either a function-based or nature-based classification, and whichever method is chosen must be applied consistently, with any change requiring retrospective restatement. Restructuring and impairment charges earn their own lines on the face of the statement. EBIT, earnings before interest and taxes, is the operating performance metric that levels the playing field across different capital structures and tax regimes. Non-operating items belong below that line, and interest expense is never netted against interest income. A SU 2015-01 closed the extraordinary items category in 2016. Every item now lives within continuing operations. An income before taxes is a required subtotal, not a discretionary one. Thank you for completing this section on operating and non-operating items.